Happy midday, everybody, and welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick from the Cusick Group, securities offered by MoneyBlock. Here to give you your midday update. Well, it looks like there's a little bit of profit taking here in the midday. It's not unexpected from the huge move up that we've had post-election. Now we see that the NASDAQ Composite's down about 0.5%. The Dow Jones Industrial is down about 0.1%. And the S&P 500 is down about 0.2%. Now, the Russell 2000, the small cap index, that still continues to climb. It is off of its start of the day of about 1.9%. It's up about 0.9% right now. So we still see that small caps, those really sensitive domestic related stocks to economic development and growth here in the United States, they continue to move to the upside. Now, what we continue to see, though, is the angst in the bond market. The thought process is that the inflation outlook is starting to increase. There is a strong potential, I'll use that word potential, right, of new fiscal stimulus on its way. It's going to introduce itself, whether it's through large infrastructure projects. It could be other types of, let's just say, tools that they've used in the past. But at the end of the day, how do you monitor it? Taking a look at right now this 10-year yield. The strategy at this point in time has been selling the bond. The longer end of the curve, the 10-year and 30-year bonds have just been getting beat up pretty badly on a price side. The yield on the 10-year bond overnight got as high as 2.3%. It's currently at 2.2%. It's up 60 basis points since the election. We talked about that in the opening bell this morning in What's Hot Now. We're going to keep an eye on that. That rotation out of bonds and into other asset classes is what's really starting to move the market. And specifically, when you look at the market, you think tech could be a segment that would be a benefactor from this potential new rotation of money into securities. Well, it has been in general. But the three laggards that have been hanging tech back are three names in the FANGs. That is an acronym for Facebook, Amazon, Netflix, and Google. Right now, Facebook is down about 335. Google is down 1955. They're both down about 3% and 2.6% respectively. Now, when you look at Apple, which is also a component of the Dow, it's down $3.09 or around 2.9%. Right around 105. Basically, the reason why these three stocks are on the downside, well, Facebook and Google, there's a potential rotation into putting money to work where they think the next infusion of capital and source of catalyst to the upside is going to be, and that's going to be in things like infrastructure products, biotech names, healthcare, and other areas of that nature, financials. Excuse me. The reason why Apple also could be taking it on the chin is the fact that there is just uncertainty right now about what the strategy is as far as economic policy from the Trump organization. There is a lot of dispute about whether or not he is going to be as inclusive, or in other words, put up walls, literally and figuratively, between trade partners. So that could impact trade with China, which would impact Apple. One sector, though, that is benefiting from the current rotation and yield increase in bonds is the financial sector. But it's not probably why you think. The short end of the curve, excuse me, the 2-year, 5-year end of the curve is not moving very quickly. As a matter of fact, the 2-year is up from its lows to about 0.97%, almost 1%. But the 10-year is up at 220. You're seeing that spread continue to steepen. When I first started talking about this on MarketStream.live, it was trading at right around that difference between the 2-year and the 10-year was right around maybe 75 basis points. It's now at 123 basis points. That means the Fed's moving slower than the longer end of the curve, which means that banks are going to start to be able to charge more in interest potentially if that curve continues to steepen, which means that they could have greater profits. We are seeing that components in the banking sector like JP Morgan Chase, Bank of America are all moving to the upside. As a matter of fact, if you look at KBE, which has those bank components in there, that's the ETF that tracks it, it's up about 1.9%. The energy sector, though, has not been benefiting from this sector rotation that we've seen out of both the bonds and other sectors. It's been underperforming. Crude has been the biggest underperformer right now in that space. The logic is that there still continues to be a very large build of crude, and there also is a lot of uncertainty now that we're getting closer to the OPEC meeting, where they were going to come up with some sort of agreement on lowering capacity and thus not bringing as much oil to market. That is not seeming like it's playing out with what we've seen from both the IEA, which is the International Energy Association, and the EIA, which is the more domestically focused energy reporting that we get from here on crude oil stocks. So I think crude's going to continue to be under pressure, and the strategy right now is not to the upside for crude. So we're going to keep an eye on that and watch all of this as we walk into the closing bell and Tech Talk. Tech Talk, we're going to break down from a technical perspective both what's going on the charts as well as in the options. Give you a little transparency there. We're going to remove some of these fundamentals and see what the technicals and the options pricing is telling us for potential moves going into some of these sectors and stocks. Till then, we'll talk to you later. Have a great rest of the trading day and take care.